G'day Amazon buyers. Today we're going to talk about the shipping container shortage and the implications of it for around the world. I'm going to quote from an article by Josh Chiat from a website called Stockhead, and it's on behalf of the International Forwarders and Customs Brokers Association of Australia. So just get a bit of inside information about why some of the reasons why we're having these shortages. Now, he starts off by saying unprecedented, abnormal, astronomical. These are some of the phrases that have been used to describe the common cold global shipping crisis, which has seen shipping container rates quadruple since the start of the year. Now, what this article covers basically is a lot of the goods that you used to get from overseas came on passenger liners. So one of the reasons why this abnormality in the market is playing out because of the interference by certain parties, one of the consequences of this is a shipping container shortage and the prices going through the roof. The cure for high prices is high prices, so it'll cure itself. I'll just quote from it. Take any flight index and it'll show you just how expensive it has become to send a 40-foot container from one end of the world to the other. The Drury World Container Index, for instance, has seen prices climb 370% to US $9,371.30 a day per 40-foot container, and that's an average. Now, I don't know how many days it takes to get a container from Australia, New Zealand, Switzerland, Germany to America or China or whatever, but $9,000 a day for a 40-foot container. Freight rates from Shanghai to Rotterdam and Shanghai to New York on the spot market are up around $13,500 a day. And anecdotally, rates can be seen as high as $25,000 on those trade lanes a day. Prices like these could cause inflation, which is not quite correct. And the inflation is causing the high prices plus the shortages, but it's another topic. But rising freight rates are not just about cost pressures for importers and high prices at your local Red Dot store. They are distorting the very nature of the global container shipping trade, and Australian importers and exporters could be among the losers in the wash-up. So how did we get here, and what does it mean for the Australian economy? In 2019, before the common cold broke out, shipping lines were not great investments. Take Danish shipper Maersk, for instance, which in 2019 reported a US $44 million loss. But in Q2 of 2021 alone, Maersk generated a profit of $3.7 billion, up an incredible 10.4 times on the US $359 million profit it booked in the second quarter of 2020. 2 years ago, the skint shippers and pure tonnage providers companies that lease ships to the shipping lines did not order new ship builds as they looked to conserve cash. So they stopped building ships because everything was slowing down. We knew that. We knew that we were heading into a downturn. The common cold shut down economies, hammered consumer spending and idled sheep fleets. But the massive stimulus packages, this is the critical point, the massive stimulus packages that followed, mainly from the debt spiraling USA, had a sudden and marked effect as trade lanes reopened amid a shortage of vessels. So they stopped the planes flying, printed a load of fiat currency, and everyone wanted to spend it on something before everything went up a bit more. And they hadn't been building enough ships because things were turning down. And so all of the world trade happens back. We've gone a step backwards onto boats now. Not that it didn't happen on ships before, but a lot of goods just came on passenger flights, commercial goods. We foresee the current crunch to need perhaps 12 months to unwind, simply due to those many factors that are now close to the limit, Copenhagen-based analyst Peter Sand from BIMCO told Stockhead. I don't know about that. I think in 12 months' time it'll be still unwinding. It'll just be worse, but we'll see. Whatever index you go by, whether it be the Drewry Index, be the Shanghai Shipping Exchange, or the Zanetta or Freightos, they are all extraordinarily elevated at the moment. You can see it going back to 2019 and even in the early days of 2020 that rates not only on the spot market but also on the contract market have risen substantially. In the United States, demand for containerized goods has risen as much as 40%. Sand said that's due to the fiscal stimulus provided to American consumers. And they have not just stopped buying containerized goods from Far East Asia since they got money in their hands, he said. That crunch in particular is on the Trans-Pacific trade lane where we have seen demand grow almost 40% compared to pre-Common Cold levels. While European demand has only risen 3%, Sand said, the demand rush in America has seen the cost of freight on the major Asia to Europe lane from Shanghai to Rotterdam soar as well. That route was impacted also by the delays caused earlier in the year when the Ever Given got stuck in the Suez Canal. I remember that, and I said this is just the start of it. Freight rates from China to Australia have soared as well, but are cheaper than levels being paid by importers in North America and Europe, and that is a big problem. As container rates run hot on the world's most popular trade lanes, increasingly ships which previously ran the routes from Shanghai to places like Australia, Africa, New Zealand and South America are being placed on more favourable routes. So all that stimulus in the US has stolen, if your contract runs out to deliver to Australia, you go and make more money on the route from Shanghai to the US because of the demand for goods and services, because of all the fake currency. It can't end well. A bit more will explain that. Some liner companies have actually opened up an extra trade route on the Trans-Pacific, and if need be, they have closed down another lane where those ships simply do not call to port anymore. Even though we see high freight rates across the board at the moment, demand growth is very located to the Trans-Pacific. We already for a couple of months have said that 12 months from now we will see a somewhat of a normalised market. I think that 12 months is still ahead of us, Peter Sand from BIMCO said. It's definitely still ahead of us, mate. More than 12. According to Brett Charlton, Tasmanian General Manager for logistics firm Agility, that puts ports like Australia at the back of the line. Charlton, chairman of the... It's not uncommon to hear of a 40-foot container from Shanghai to Los Angeles to be around $25,000 freight. Even then, you're still struggling to get that space and people are paying for it. They need to get it, he said. In Australia at the moment, prices are around $8,000 to $9,000 for delivery to the east coast of Australia. That's where they've landed, but they're probably going up. In fact, they're going up $1,000 per container on the 1st of August. At the moment, shipping lines are increasing rates at a quantum of $300 to $500 per day, maybe, for a 20-foot container. Double that for a 40-foot container every 14 days, Yeah, they're going up $300 to $500 US, and double that for a 40-foot container every 2 weeks. If you put yourself in the minds of the shipping lines, you have another issue, and this is not just the price, this is the capacity to be able to service the market. If you're a shipping company executive in Australia and you're speaking to your contemporary over in Shanghai and say, I need 1,000 containers for the next 2 weeks, the person in Shanghai from the same shipping line is saying, how much revenue are you getting for each of these containers? That's where it gets tricky for the Australian executives. The guy down here is paying $8,000 a container, Charlton said. This guy in China is saying, why would I release my containers to you when I can get $25,000 a container to the US or to Europe? So there's a real struggle internally with the shipping lines to justify an equipment request, and there's a real equipment deficit at the moment in China. We've got some cheap cargo that's been waiting there since May to get a ship because we can't get a container or a spot. shippers are under pressure to push the bottom line. Remember that those pure tonnage providers we mentioned earlier, they are another reason shippers are going to prioritise higher routes. According to Sand and Charlton, virtually every ship that can be deployed is deployed at the moment. It is still not enough. I think, of course, in terms of profitability, certainly the container ship liners are the winners, and also we call pure tonnage providers those who own the ships, Sand said. They went from hell to heaven from 1 year ago to right now. 1 year ago, these tonnage providers issued statements where they would run out of cash. Today, they are reletting their ships at record high charter rates, even old skints, ships that burn an enormous amount of fuel when compared to an efficient modern ship. That brings to mind a bit of the other disaster, so-called manufactured disaster that they've got going, but we'll talk about that another day. Charlton said this will put pressure on major shipping lines like Denmark's Maersk, Switzerland's MSC, France's CMA ACM, Germany's Hapag Lloyd, and China's COSCO to raise higher value trade lines where the Trans-Pacific, like the Trans-Pacific and Europe. We're seeing massive delays and massive costs coming down the line, but there's more risk because the shipping lines themselves are getting increased costs, he said. The shipping lines only own a portion of their fleets and the rest are chartered by ship owners predominantly based in Europe. I heard a story where one of the ships, I won't name the line because it was given to me in confidence, I think it was about a 9,000 TEU ship, so it carries 9,000 20-foot containers, and it was on the run from China to Australia. That charter agreement between the shipping line and the charter owners runs out in August, and the charter owner has said that the ship was in 2019 chartered for around $10,000 a day for a period of 12 months. Now the people that own the business are saying $50,000 a day, and you have to commit for 3 years. So it's not difficult to understand basic economics. If you're a shipping company and you say it's going to cost me $50,000 a day to have that ship, and the freight rates are only $8,000 a day, that ship will be lost to the Australian market. It will go and be redeployed back up to the Asia-US and Asia-Europe trades routes where they're getting $25,000 a day. Because some routes are so much more profitable than others at the moment, shippers are ferrying more air around the world than ever before. As Charlton explains, this is an issue for exporters. Under normal rate conditions, containers imported to Australia are filled with Aussie exports on the return leg, which in turn helps the shipper cover the costs. But when prices and demand are so biased towards other routes, getting the empties back to China or another Chinese Yantian or another Chinese port as quickly as possible is the number one priority. The flip side of this is it affects exporters as well, because containers for here are used for export back out, Charlton said. So at the moment, where I am in Tasmania, it's hand to mouth. We're constantly trying to find containers for our exporters to export out. And the bizarre thing is that demand is high. People want our agriculture. They want our aluminium. They want our zinc. They want our Mondelez milks and cheeses. I'm just talking about Tasmania. While a ship's capacity is measured in container units, the reality is it can only carry so much weight. A ship may be able to carry 8,000 containers, but if 5,000 of those containers are really heavy, that's all you can carry because it's a ship on water, Charlton said. At the moment, a 20-foot freight rate from here to Shanghai is only around $650. It's not that expensive. But if that container weighs 27 tonne, they can get effectively 13 empty containers on that ship. So rather than have a container full of export going back to China, they'd rather say we won't carry any full cargo. We'll just get our empty containers back, because as soon as we get those back, they can be redeployed into the Asia-US and Asia-Europe trade. According to Charlton, some shipping lines have cancelled routes to less profitable and more logistically challenging destinations like the Middle East and India, so they can service the priority Europe and US trade lines. We've got a container to go to New Delhi that's ready next week, and not one shipping line can tell me when they can take it, Charlton said. they've got no interest in having that container going from here to India. So when you hear Austrade or someone else saying we need to diversify our exports away from China, that's lovely. But the shipping lines don't want these containers anywhere near those places. They want it back in China so they can get their containers back there and out to ports. So if we've got trade issues with China, which we have, it's a double whammy. The container situation has been exacerbated by cost cutting that saw shippers order less containers to service new build ships before the common cold swept the world. Even though container manufacturers have been building rapidly over the past year or so, the vacuum is still there. We used to go by a multiplier of 3. When a ship owner ordered a new ship, say a 5,000 TEU ship, he ordered 15,000 TEUs, 15,000 20-foot or 7,500 40-foot containers of empties to go with that ship. But cutting costs and seeing some economies of scale moving into this, when you buy a new ship today, you only buy twice as many empties. So that extra number of containers that was always around a decade ago or even 5 years ago is not there anymore. Container manufacturers are producing whatever they can. There were only a few around, so they were busy. But there's a massive gap between a multiplier of, say, 2 boxes per shipping capacity and 3 as it once was. With just about every container ship in the world out on the high seas, shipping lanes and ports are facing unprecedented levels of delays and congestion, which is adding to issues for importers. That is even more bottlenecks from the Ever Given incident in the Suez Canal, where the container ship got jammed. Common cold outbreaks at major ports, including Yintan, and industrial action between Australian wharfies and port terminal operators are taken into account. Many ports, too, are being impacted by labour shortages or are not set up to deal with the volume of trade demand currently being driven by international stimulus spending. Down here, for instance, in the business I run, we manage all the logistics for the fishery manufacturers for the salmon farms, Charlton said. 2 large multinationals have got 55 to 65 million plants that make fish feed for the salmon industry here and also export for New Zealand. You can't get protein sources from Australia to equal what they currently get from overseas, so they have to bring them in. Sometimes it's 20 or 30 containers at a time depending on the formula. That product, Charlton said, comes primarily from Peru. In Peru, there's no equipment, he said. There's more empties in different places rather than where they need to be. The transshipment port of South America is so congested that the shipping line, being MSC, has redirected those containers to Europe. So what's traditionally a 55-day transit time is now 90 days. So they need to account into their supply chain an additional 40 days. There's a piece of 40 days where that hasn't been accounted for because it happened so suddenly. So here's a real situation where some of these raw materials just aren't going to be available to make these sorts of products. You hear these stories quite regularly. Port issues in Australia during periods of industrial action could also see shippers redirect ships to less lucrative but logistically faster lanes. There's no shortage of disruptions that if you're a shipping executive in Geneva, sipping on a wee dram of Chesterfield in front of the fire, and you go, okay, where am I going to deploy my assets? Australia is at the bottom of the list, Charlton said. We're not ticking many boxes at the moment. We haven't got the freight rates to rival Asia-Europe, Asia-America. We have longer type transit, 17 days, so the equipment is being utilised for a longer period of time than the inter-Asia trade. So the freight rates may be cheaper between China and Malaysia, but that ship can do 3 voyages compared to 1 voyage down here, so they get triple the revenue. Further headwinds could be faced with sources in the logistics industry saying international airliners are looking to pull out of commercial airline routes which double as freight lines for the produce like salmon, prawns and lobster. That situation has emerged as stricter arrival caps imposed by Canberra following common cold outbreaks out of the hotel quarantine have obliterated the financial viability of international passenger flights. While some perishable goods are exported on charter planes under the government's IFAM program, Most exports are too bulky to be exported via plane, and passenger flights are the main carriers of air freight. How long will the global shipping crisis take to unwind? According to Sand, BIMCO does not see any easing of this supply-demand crunch until the latter half of next year. When exactly the 12 months unwinding period predicted by BIMCO will start is unclear. Like I said, could be a lot longer. We already for a couple of months have said that 12 months from now we may see a somewhat of a normalised market, Sand said. I think the 12 months is still ahead of us, to the extent that we have seen in those previous 2 months has been still an escalation of those supply chain dynamics. That's not working towards an easing of the crunches. It has simply made the supply chain crunches tougher to deal with, and that to us explains the most recent hike in freight rates. For the shippers, it will still be quite costly, at least compared to pre-pandemic levels, to ship goods around the world, but for the liner shipping companies, it's certainly windfall profits. I might stop there. I think that's enough information. What I would like to say of my own VAT is we're going to see a currency crisis. We're going flat out headlong into a currency crisis. So what was true today is going to be not true tomorrow. So all of those consumers that are ordering all those goods, sooner or later, the exporters of those goods are not going to take the US dollar. Sounds stupid, sounds incredible, sounds unprecedented, but we're in unprecedented times. And that US dollar is going to disintegrate. It should have already disintegrated for the amount of it they've printed out of thin air. So we're going to get these gyrations where the shipbuilders are flat out building enough ships, and then all the guys that are spending their US dollars, all the people that are in the US that are spending their stimulus checks, none of the vendors are going to want to take the US dollar. So somewhere, somehow, we're going to end up with a shitload of containers sitting around doing nothing, and a shitload of ships sitting around doing nothing, shipping companies going broke, while the average, because the average vendor will not want to take the US dollar. They will demand something else in payment, and who knows how long that'll take to play out, but it's going to flip back around. In the meantime, yes. In the short term, yes. No one's going to want to send containers to Australia, and imagine that we can't get our exports into the containers to get them out of here. Our stuff's in demand, but what cures it? Extremely high prices to make it viable. You've got to make it viable. You've got to catch up to the rest of the world. But then our exports are not worth what they were. They're too expensive to get around the world. So I can see, and I predicted this in March of 2020 when all this authoritarianism, dictatorship took over, and they locked everyone in their homes and stopped them producing stuff, that this sort of lunacy had to happen in the financial markets. So if we can't sell our stuff, to put it really simply, we don't have the income. And Australia has always been a free trade nation because we've understood that we're an island at the bottom of the world, and that we need those ships coming to our ports, one, to export, and two, to import. And without that trade, we're on our own. We've got all the resources, but we don't have the manufacturing base any longer to process the raw materials. We sent that overseas a long time ago with minimum wages and health and safety regulations and environmental laws. A lot of our factories are closed up and buggered off, especially the major heavy industries, the tyre factories, the steel manufacturing industries. They're all gone. We can't start making our own cars again overnight. We've got to get some experts in and allow and remove the red tape. And who knows what, in the coming crisis, the red tape might be meaningless. We'll have a black market in factory building, and it won't matter because no one will be able to regulate it. Who knows? But in the short term, it's straight from a first world lifestyle to a third world. Shortages of everything. Thanks for listening, guys. I'll see you on the next one.